Hello out there in cyber accounting land. Professor Ebit here to help you master it quick. In this session, we'll look at the accounting for corporation bonds. We'll look at why companies use bonds to raise money with, the entries when they sell the bonds, what happens if they have the bonds sell at a premium or a discount, and then finally, what if they pay the bonds off early, like you or I might pay a loan off early to save interest? Companies do that sometimes too. Now, when we get there, you'll see that event can possibly cause there to be a gain or a loss, which we'll see in a few minutes when we get there. First, the reason why companies use bonds is they're borrowing a very, very large amount of money, probably to buy another company with or something big. You might say, well, why don't they just use a bank? The reason is because the money that they need is too much for one bank to lend it to them. So they may need to use two banks. All right, so now you got two banks in the picture, and neither one of them wants to be second in line to be repaid. So that's why you employ the power of buying from, or selling to, I should say, large numbers of investors, these bonds, and you can raise $500 million, which is the typical size of a bond issue. Now, in the examples we're going to look at, we'll use maybe 100,000 or a million because it makes an easy multiplication. But in real life, you'd never see a bond issue that small. Now, bonds are also a safer investment than shares of stock. One big reason is because the bond contract requires the company to do two things. The company selling the bonds is really borrowing money from the people who buy the bonds. So the bond contract specifies the interest rate that the investors are to be paid. In the examples that we're going to look at, we'll use one interest payment a year, but in real life it's done 2 times, so every 6 months. And when are the bondholders to be repaid? In other words, what is the maturity of the bond issue? Typically it's very long, 10, 15, 20, sometimes even longer than that, years. So because the bond contract is there, the investors have the protection of, if the company fails to make interest payments or fails to pay on maturity, the investors can foreclose. They can come in and force the sale of assets so that they will be paid the interest and principal that they are due. So even in a bankruptcy, bondholders rank very, very high in the pecking order of people who are to be paid off. So that's why they're regarded as a safer investment than stock is. Most corporation bonds are traded on public exchanges, which makes for some extra work on the part of the company selling them. They have to register with the SEC, make a prospectus, which is for the investors to read. And a prospectus is about the size of a telephone book and is very good reading some night when you can't get to sleep. But the SEC requires that it be available to investors should they want to read it. There's also the bond underwriter who gets the bond sold for you. So the cost to get the bond issue in place, we're kind of steamrolling over them with what we're looking at here. But in real life, they can be significant. It can be 6 or 7% of the total bond issue. They're referred to as flotation costs. And one of the jobs the bond underwriter has is to help you size the issue. So if you need $100 million, you may have to sell $107 million worth of bonds to be able to pay all the flotation costs. Now, if they are publicly held bonds like that, when they begin to trade, one investor can sell the bond to another one rather than hold it until it matures. Now, how much they might get depends on a number of factors, many of which also affect when the company goes to sell the bond. So that's why I wanted to spend a couple of minutes talking about this point. Once the bonds are out there, if you were to look them up in a financial newspaper like Barron's or Wall Street Journal, you'll see the price shown as a percentage of the face amount, which is called par. A bond that has a price of 100 means it's selling for 100% of its face value, or it's selling at par. Now, that can happen if the contract rate that the bond pays is exactly the same as what investors could get elsewhere. If those two rates are the same, the bond will sell at par. We'll look at why in a couple of minutes. Sometimes the bond will sell for a price higher than par. That'll show up as a number bigger than 100. So I used 102. That means that that bond is selling for 102% of its face amount. Now, why is that? Because the contract rate on that bond is better than what investors can get elsewhere, so that bond commands a higher price. Now, exactly why, we'll see in a couple of minutes. As you might expect, 98 means that the price is not up to par because everybody else pays better than that corporation bond. So the contract rate on that bond is not as good as the investors could get everywhere else. So the bond has to discount the price in order to be able to sell it. Now, specifically how investors price bonds, we look at very, very closely in corporation finance class. But here, we're just going to talk about the idea. What a bond price represents is the present value of two amounts. Number one, the present value of the maturity amount when the bonds mature, which could be many, many years from now, and the present value of the annuity of interest payments that the investor will get if they buy the bond. Those two present values added together will come up with the price an investor is willing to offer for the bond. Now, present value is another way of saying you're discounting a future amount. The amount that you discount it with will depend on a number of factors. One is how much inflation do the investors expect there to be? A lot of inflation, they'll look for a higher interest rate. Less inflation, not as much. Risk. How much risk do the investors perceive on the part of the company in terms of how able are they to repay the bonds and how able are they to make the periodic interest payments? A lot of risk translates into a higher rate. The investor demands higher rate to protect themselves. Less risk, not as much. So all that stuff goes into the rate that the investors use when they calculate the present values. So basically that is why bond prices and interest rates are inverse. When interest rates are higher, investors discount those sums more and are willing to offer less to buy the bonds. When interest rates are lower and investors do their calculation, they don't discount the amounts quite as much and the bond prices are higher. Depending on the relationship between the market interest rates and the contract rate available on the bonds, three possibilities might happen when the company first sells the bonds. The first entry illustrates a sale at par, in other words, a price of 100. That's because the contract rate on the bonds is just the same as what's available every place else. All right, that's an easy entry. It's like a big note. The company debits cash. Now again, I'm using $1 million because it's an easy illustration. Real life, you'd never see a bond issue that small. We're debiting cash for $1 million and crediting bonds payable for $1 million. Bonds payable is, of course, a liability. That means the company's got to pay back $1 million to the investors when the bonds mature. Now, that's the case regardless of what they sell them for. Let's say in the second case here, market interest rates are quite a bit higher than what our bond pays. We can only get a price of 95 when we sell our bonds. Okay, that caused there to be a discount. When we sold the bonds, we received $950,000 cash. It was the best we could get at the time. How much do we have to pay back when they mature? Still $1 million. So that's why there's a debit to an account called bond discount for the $50,000 discount amount. Now that's going to need to be amortized out, which we'll see in a few minutes. But that happened because the market interest rates were higher than what our bond paid. The third possibility could be just the opposite. Our bond might pay much better than everybody else does. That's what's being shown in the final entry there. If we can get a price of 105 when we sell our bonds because our contract rate is much better than is available in the market, we'll get a premium price. Cash comes in $1,050,000, even though we're only obligated to pay back $1 million when they mature. So the $50,000 is on the credit side now, and it's called bond premium. That also will have to be amortized out, which we'll see in a couple of minutes. Now, here's something that will always help you understand. The bond discount, when it's amortized, we're going to try to make that account go down. So you see how it's in there as a debit? When we amortize it, we're going to put credit entries into that account. Now, as you'll see, the debit side is going to go to interest expense. So in other words, the effective interest cost is higher when there's a discount. Here's why. The company has to pay back $1 million, but they only have the use of $950,000, so it makes it more expensive for them. The opposite happens in a case of a premium. The bond premium went in on the credit side, as we see here. When we make that account drop, we're going to be putting debits into that account, which means the other side of the entry will go to interest expense and make it less. Okay, why is it cheaper? The company is obligated to pay back $1 million, but they have the use of $1,050,000, so it makes it less expensive for them. Now that the bonds have been issued, the company will have to make interest payments on them according to what the bond contract says about the rate and the payment date. Interest is almost always paid for a period going by, so Smith Company will have to pay it starting on January 1st. In this case, let's suppose the contract rate is 4%, the bond term is 10 years long, and the payment date is January 1st of the following year. Smith will have to accrue interest on the bond for the 2015 year, just like they would for a note. The amount is determined, as it is in a note, principal times rate times time. So $1 million times 4% times 1 year is $40,000. So the entry that Smith makes on 12/31/15 is a debit to interest expense for $40,000 and a credit to interest payable for $40,000. When Smith sends the checks out to the investors, it's just like paying off interest payable. So January 1st of 2016, Smith debits interest payable $40,000 and credits cash for the same amount. Had Smith's bond contract specified a 12/31 interest payment date, they wouldn't have to accrue. Just record the expense when they paid the checks out on 12/31. In this illustration, we'll see what happens when bond discount is amortized. Now remember, how the discount happened was when the bonds were sold, we were not able to get full price because the contract rate on our bonds was not as good as was available everywhere else for bonds of similar length of term and similar level of risk. So we sold them for less. What we're looking at here is known as the straight line method for amortization of bond discount, which GAAP will allow if it is not materially different from the effective interest method. We'll talk about that in a couple of minutes. If you're using straight line, you take the amount of the discount, $50,000 in our case. Now remember, the bond term was 10 years long, so that's why we're dividing by 10. So we're seeing how much should be amortized for just 1 year. All right, in our case, it should be $5,000. And as we said, we're trying to make the bond discount account drop. So you see how it went in as a debit in the sale entry? In the amortization entry, we're going to put a credit in there for $5,000. So in other words, it'll be $45,000 after we amortize out a year. How about the other side of our entry? As we said, it's going to be a debit to interest expense. Now, this is very important. This does not change how much we have to pay the investors. That's purely driven by the contract rate. So with a 4% rate on these $1 million bonds, we got to give them $40,000 every year. This is putting interest expense on the issuing company's books because the effective interest cost is increased in case of a discount. As we said, it's more expensive for us. We're borrowing $1 million, but we only have the use of $950,000. That's why it's more expensive. So when this company makes their income statement for the year, the total interest expense on the bonds is going to be $45,000. The $40,000 that we paid out plus $5,000, which is coming from the amortization of the discount. As we amortize it out, the carrying value of the bonds will go up. On day one, the carrying value of the bonds was $950,000. We had $1 million of bonds, and we had not amortized any discount yet, So the unamortized bond discount on the first day was still $50,000. Now that we've amortized $5,000 of it out, the unamortized amount is $45,000. So on the balance sheet for 12/31/15 for this company, they would show bonds payable $1 million less unamortized discount of $45,000. So the carrying value is now $955. Next year, it'll be $960. The year after that, $965. By the end of the 10th year, we amortized out the whole $50. There is no unamortized discount, and the carrying value comes back up to the face amount. Now let's look at the case of amortization of premium. Now remember, how the premium came to be is our bonds had a better contract rate than everybody else, so they commanded a higher price. When we sold them, we got $1,050,000. We have to pay back $1 million when they mature, so the $50,000 went into the bond premium account over on the credit side. All right, using straight line, we take the $50,000 divided by the number of years in the bond term, so once again we have to amortize $5,000. But this time we're amortizing premium. We want the bond premium account to drop. So we're going to debit bond premium for $5,000, and the credit is to interest expense. Now again, this does not change how much the company has to pay the investors. Purely contract rate. So 4%, $1 million, we got to give them $40,000. But the effective interest cost on our books is being reduced. How come? We have the use of $1,050,000, but we only have to pay back $1 million when they mature, so it makes it cheaper for us, effective interest cost. But always remember, the amount that has to be paid to the investors is contractual. It's being driven by the bond contract, and we have to make those payments hell or high water. If we don't, the bondholders can foreclose. So on the balance sheet, after this is done for the first year, here's how the carrying value would look. Remember, on day one, carrying value was $1,050,000 because we hadn't amortized any of the premium yet. After we amortize out $5,000 of it, the bond premium is now $45,000. So the bond carrying value is $1,045,000. Next year it'll be $1,040,000. The year after that, $1,035,000. At the end of the 10th year, there'll be no amortized premium left, and the carrying value will be the same as par, $1 million. The other way there is of determining the amount to amortize is to use what's known as the effective interest method. The idea is still the same. Amortizing the discount is going to make the interest expense higher. Amortizing the premium is going to make it less. But how you get the amount, instead of taking the amount of the premium or discount and dividing it by the years, it's determined from an amortization chart which will compare these two amounts. The par of the bond issue times the contract rate as compared to the carrying value times the market rate. Those two amounts are compared, and the difference between the two is the amount to use for the amortization for each year. If all of the entries have been made to amortize either premium or discount, when the bonds mature on January 1st, 2025, Smith Company will make the following entry. 1/1/25, they'll debit bonds payable for $1 million, which is paying them back, and then credit cash for $1 million. So they're giving all the investors their money back. See how it's like paying back a note? Smith also might pay the bonds off before maturity. This is called redemption, not saving souls, but rather repaying bonds before the maturity date. The reason is to save interest payments, just as you and I might pay off a loan early to save money. When they make that redemption payment, there might possibly be a gain or a loss on the transaction, as we'll see. It'll depend upon the carrying value of the bonds and how much is being paid to redeem them. Many times a bond contract will require an extra payment if the company wants to pay the bonds off sooner than the maturity date. This is negotiated in on behalf of the investors buying the bonds. When they bought the bonds, they expected to get periodic interest payments for a certain period of time, and that got priced into the bond when it was sold. If the company wants out of the arrangement, which might be worthwhile, because remember, if they pay the bonds off, they don't have to make those big interest payments anymore. Just the same as if you or I pay off a car loan or a mortgage loan, we escape making interest payments too. So that is why the redemption price will sometimes be above 100. Let's look at what would happen if 5 years into the bond contract, remember they were sold on January 1st, 2015. If on January 1st, 2020, our company here wanted to pay these bonds off, let's look at what would have happened. Now, I'm looking at the illustration of when they were sold at a discount. Remember what happened when they were sold. The cash that came in was $950, the bond discount was $50,000, and the company had to pay back $1 million. When they pay them back, in our illustration here, they have to pay a premium price. You see the redemption at 102. Okay, that means the company is going to have to pay 102% of $1 million, or $1,020,000 in cash when they redeem. So let's take a look at our entry step by step, and we'll see why we have what we have up here. First job is, let's picture what the carrying value would be of the bonds on 1/1/20. All right, 1/1/15, your carrying value was $950. Remember, you had $1 million of bonds payable minus an unamortized discount of $50,000. That's why it was $950. We've been chopping away at it $5,000 a year, so we amortized out. By the time you get to this point, we've amortized out 5 years of bond discount. So how much unamortized discount is still left? $25,000. All right, so that is why when we do this entry, we have to get rid of that unamortized discount of $25, because the bonds are being paid off. There's not going to be 5 more amortization entries that happen after that. All right, so what was your carrying value of the bonds? At that point, it was $975. $1 million of bonds minus unamortized discount of $25,000. The carrying value was $975. Now, let's follow our entry. We're debiting bonds payable for $1 million. We're getting rid of them, paying them off. We are getting rid of the rest of the bond discount of $25,000 because it's not going to get amortized out in the normal course of events. We're paying them off now. We're writing out a big check for $1,020,000, so that's a credit to cash. All right, so let's start looking at the money. You got $1,045,000 on the credit side here. There's $45,000 going into an account called loss on redemption, because that would give us $1,045,000 over here, so the entry would balance. Okay, why is there a loss? Let's look and see. We're paying $1,020,000 to get rid of an obligation that has a carrying value of $975. Anytime we pay more than the carrying value of the obligation, it causes there to be a loss on redemption. In this case, $45,000. Had we been able to redeem them by paying less, there'd have been a gain on the redemption. In this case, there was a loss. Now, you can also force that amount. You're crediting cash for what you got to pay, $1 million times 1.02. You know you got to get rid of the other 25 of unamortized bond discount. You know you're debiting out $1 million worth of bonds, so if you want to, you can force how much the loss was in order to make your entry balance. So anytime we pay more than the carrying value, there's a loss. Anytime we're able to do it for less than the carrying value, there'd be a gain. So is redeeming these bonds early worthwhile? Hell yes. The company experienced a $45,000 loss, as we see, but they paid off those bonds 5 years early, which means they avoided 5 payments at $40,000 a pop, would have been $200,000. So I would say the company made out rather well on that deal by paying it off early. Even if there's a loss, which might even produce a tax benefit under certain circumstances for the company, the amount that was avoided certainly made it worthwhile in this case. So now you've seen the accounting for corporation bonds, and I think that you will find yourself well versed for being able to answer exam questions about this topic, which is, of course, what we're trying to do. So this is Professor Ebit checking out. I'll see you next time.